Welcome to the Lion's Share podcast, where we break down today's most impactful research and bring fresh insights from the academic frontier straight to you.
You know, if you're getting ready for a comprehensive exam in corporate finance or maybe launching a new research project, you always start at the same place.
The Modigliani-Miller Theorems.
Exactly. But today, we're not just going to recite MMI and MM2. We're doing a deep dive into Marco Pagano's 2005 paper, The Modigliani-Miller Theorems, a cornerstone of finance.
And for you, our listener, this is really about dissecting why. Why do these propositions from 1958 still form the bedrock of, well, everything in modern finance?
That's the mission. We're looking at Pagano's paper as a kind of meta-analysis. Why does every paper start by referencing a framework that we all know is, fundamentally not true in the real world?
And Pagano's answer is just brilliant in its simplicity. He argues it boils down to two things, two cornerstones.
Their substantive value as these so-called irrelevance propositions, and their methodological value, which is all built on the idea of arbitrage.
It's such a crucial distinction. The substance tells us what to look for, and the methodology tells us how to look for it.
Okay, so let's start with the substance. The irrelevance propositions. Modigliani and Miller's big claim, under some very strict conditions, was that a firm's value has nothing to do with how it's financed.
Right. Your capital structure, your dividend policy, none of it matters.
Which is so powerful precisely because we know that in reality, of course, these things matter.
That's the genius of it. They provide the perfect, frictionless laboratory. MMI and 2 aren't meant to be a description of reality. They were designed to force intellectual discipline on a field that was, frankly, a bit descriptive.
So the implication is that investment and financing decisions are completely separate.
Totally decoupled. Value comes from the assets, from the cash flows they generate, not from the legal claims written against those cash flows.
So the real value isn't the result itself, it's the analytical clarity it gives you.
Absolutely. If a choice doesn't matter, it's irrelevant. But if it does matter in the real world, then you are immediately forced to ask why. You have to find the friction.
Merton Miller said it best, didn't he? Showing what doesn't matter can also show, by implication, what does.
And that's it. That's basically the entire research agenda for corporate finance for the next 60 years, all in one sentence.
But to get to that clean, powerful result, the assumptions they made were incredibly demanding. Let's just quickly run through the three big ones.
You have to start with this trifecta of perfection. First, no taxes, not corporate, not personal.
Okay.
Second, no bankruptcy costs. And that's not just the legal fees of liquidation. It's the reputational damage, the management distraction, all the soft costs.
And the third one is the big one.
Perfect financial markets, which means they're competitive, they're frictionless, and, crucially, there's no asymmetric information. Everyone knows everything.
So if you think you're adding value with a financing decision, you have to be exploiting a violation of one of those three conditions, period. This is where we can pivot from the what of the theory to the how of the proof. This is Pagano's second cornerstone, the methodology. Using an arbitrage argument in the mid-50s was, well, groundbreaking.
Oh, it was a seismic shift. Before finance was mostly accounting, some institutional description. They brought in formal, deductive economic reasoning. And the beauty of an arbitrage argument is that it's actually less demanding than assuming a full competitive equilibrium.
How so?
The idea that there's no risk-free money machine just sitting there, the absence of arbitrage, is just a much more fundamental concept. It's a very robust starting point.
What's amazing, though, is how clunky their first proof was. Pagano points this out. It was this 30-page laborious argument comparing two firms.
It was. They used what we now call synthetic replication, or homemade leverage.
Can you just walk us through that logic quickly?
Sure. The idea is if you have two identical firms in the same risk class, but one is levered and one isn't, they have to have the same total value. If the levered firm was priced higher for some reason,
then you'd have an arbitrage opportunity.
Exactly. An investor could sell the overpriced shares of the levered firm, buy the cheaper shares of the unlevered firm, and then just borrow personally to recreate the exact same leverage.
And pocket a risk-free profit.
Right. And the very possibility of that action forces the two firms' values to be the same.
But the real insight, the one that connects to all of modern asset pricing, is this idea of a linear price rule.
That's the modern, much cleaner proof. The absence of arbitrage implies linearity. It just means the value of the whole must equal the value of the parts.
So the firm's total value is set by its assets and their cash flows. That's the whole.
Right. And the claims on that, value, debt, equity, whatever, are the parts. You can slice up the pie any way you want, but you can't change the size of the pie just by slicing it differently.
Unless, of course, slicing it creates or destroys value because of a friction.
That's the key, unless a friction breaks that simple linear addition.
And this is why you can draw a straight line from to, say, Black-Scholes.
Without a doubt. The entire field of derivatives pricing is built on this foundation. You're pricing a redundant security through arbitrage. Miller himself used to say that the put-call parity theorem was just proposition I in disguise. It's the same core insight.
Okay, so we had this powerful, perfect market benchmark. Now let's do what everyone has done for the last 60 years. Smash it against reality.
And Pagano frames this beautifully. He says the entire history of corporate finance since 1958 is just the sequential relaxation of those three assumptions.
Starting with the one they relax themselves. Taxes.
Right. That was the easy one. You introduce a corporate tax system where interest payments are deductible, and suddenly debt has a clear advantage. An optimal capital structure appears.
But it's not that simple, is it? Because then you have to layer on personal taxes.
Which can push in the other direction. You get this considerable downward revision, as Pagano calls it, of just how much value you can really create with leverage. The magnitude of the effect starts to get complicated.
And that leads to the second friction, bankruptcy costs.
This gives us the classic trade-off theory. You add debt to get the tax shield. But as you add more debt, you also increase the probability of financial distress.
And the costs associated with that distress.
So you're looking for that sweet spot, that interior optimum, where the marginal benefit from the tax shield equals the marginal cost from the rising bankruptcy risk.
But Pagano points out there's a big academic debate here. The estimated direct costs of bankruptcy, they just don't seem big enough.
It's a real puzzle.
Yeah.
They don't seem large enough to explain why so many companies are, so conservative with their debt levels. If the tax benefits are so huge and the bankruptcy costs are relatively small, what's holding them back?
And that's the pivot. That's what forces us to look at the third friction, the one that, in Pagano's words, unleashed a truly tidal flow of advances.
Asymmetric information.
We're talking adverse selection and moral hazard between the people running the company and the people funding it.
And here, the whole linear price rule just breaks down. Suddenly, how you structure the financing, how you allocate control rights and cash flow rights, that becomes the central economic problem.
It's not just about raising money anymore.
No. Financial instruments become tools for screening projects, for contracting, for managing incentives. It's why you see things like debt emerge as an optimal contract in certain models, or why venture capitalists use convertible debt and staged financing.
It's all about managing information problems.
Exactly. And of course, it also means that your financing choice sends a message. It becomes a signal.
The signaling literature. This is huge.
It is. Leland and Pyle showed that the more equity a founder keeps, the stronger the signal of their confidence. And Myers and Mageslove famously argued that issuing new equity is often seen as a bad signal.
Because managers would only sell new shares if they think the market is overvaluing them.
Precisely. The financing decision itself reveals private information about the underlying value of the assets.
It's incredible how much research has come from relaxing just that one assumption. I mean, Jean Tirole wrote a 1,000-page book dedicated almost entirely to these kinds of models.
Which really brings up a critical question for you, for anyone doing research in this area today. Is the old perfect market assumption still the most important one to relax? Or have informational and governance frictions just completely taken over as the dominant force?
I think you'd have to argue it's the information friction, because it fundamentally changes what a security is. Taxes and bankruptcy costs are, in a way, just adjustments to the cash flow. Information asymmetry changes the strategic game theory between all the players.
But we only know to ask that question because first gave us the benchmark where information was perfect.
That's the value of the benchmark. It always brings you back. Now let's talk a bit about the legacy. We have to touch on that vague concept they use, the risk class.
Right. It was a bit hand-wavy in 1958, but it was necessary. It took later asset pricing models, like the CAPM, for people like Stephen Ross to come along and make it precise.
How did they redefine it?
Well, if you accept a model that only prices systematic risk, then same risk class just means the firms have the same beta. Their covariance risk is identical, even if their idiosyncratic risks are totally different. It was a very neat way to tie directly into modern portfolio theory.
Pagano is also pretty direct about their empirical work, calling it a less lasting aspect of the legacy. That's a strong critique.
I think it's less a critique of them and more a reflection of just how hard empirical corporate finance is.
Because nothing is ever truly exogenous.
Nothing. A firm's financing choice is never random. So you have this massive identification problem. To get a clean test, you'd have to simultaneously model the effects of taxes, bankruptcy costs, and information problems. It's an econometric nightmare.
So for a manager in the real world, how does this help? If the theory says financing is decoupled from investment, how do you use that to actually justify a capital structure choice?
You use it as a kind of negative screen, a discipline tool. The framework forces a manager to ask, what friction am I exploiting here? If this financing choice doesn't clearly get me a tax benefit, or solve an agency problem, or send a positive signal,
Then it's probably just irrelevant at best.
or value destroying at worst, once you factor in transaction costs, it demands intellectual rigor about where the value is actually coming from.
I want to end on a point Pagano makes about Modigliani's intellectual independence. It's fascinating. Right in the thick of the rational expectations revolution, he was willing to entertain the idea that managers were just, irrational.
It was a very brave stance for the time. He and Cohn wrote that famous paper in 1979 arguing that the stock market was systematically mispricing the effects of inflation. That's a behavioral argument, long before behavioral finance was a mainstream field.
Which pushes us to, I think, a really deep question for today. If is our perfect rational benchmark, but we also take Modigliani's skepticism about superrationality seriously, how do we build models that incorporate investor or manager irrationality without just, throwing our hands up and losing all analytical clarity?
It's the tightrope we're all walking now. You can't just say people are irrational and call it a theory. You have to introduce specific, documented biases, overconfidence, loss aversion in a disciplined way.
So you can still get testable predictions.
Right. The real challenge is moving from using behavioral finance to explain weird results to using it to design optimal contracts and policies from the start. That's where things are heading.
Which brings us right back to the beginning. The Modigliani-Miller Theorems are less about telling us what's true and more about giving us the structure to ask the right questions. They force that discipline.
They gave us the research method. The great papers are all just the most successful attacks on the weakest points in the fortress.
So as you think about your own work, remember this core insight. Value is conserved unless a friction intervenes. And here's a final thought to leave you with. What is the next big friction? What new, non-traditional force, maybe it's related to climate risk or technological disruption or social governance, is going to be the basis for the next major breakthrough, forcing us to relax an assumption in a way no one has even thought of?
Thanks for tuning into the Lion's Share podcast. If you enjoyed today's discussion, share it with a friend and join us next time for more ideas worth talking about. We'll see you next time.